There's a strange kind of silence before a storm. Markets are uneasy, CEOs are pausing investments, and layoffs are quietly starting to creep in. And more headlines are using a word that we all hoped we will not hear so soon: recession. But this time it feels different because it is not just the usual cyclical slowdown. It is coming on the back of fresh global trade tensions, rising geopolitical uncertainty, and an environment where policymakers have fewer tools left in their kit. So, in today's video, let's break down what's happening, how it might impact India, especially our IT sector, and what smart investors can do now to protect themselves and maybe even benefit from the downturn. Let's begin with the global backdrop. In early April 2025, JP Morgan increased the probability of a US recession to 60%, citing escalating trade tensions and signs of a global slowdown. On Polymarket, a prediction market platform, the odds of a US recession in 2025 surged to 64% following new tariff announcements by the Trump administration. President Donald Trump declared Liberation Day on 2nd April, imposing sweeping tariffs that included a 10% baseline tariff on imports from most countries and a 34% tariff specifically on Chinese goods. In retaliation, China announced its own tariffs. And these developments have set off alarm bells across boardrooms as global trade, which had barely recovered from pandemic era disruptions, is now facing significant rerouting. Supply chain managers are scrambling, orders are being delayed, and businesses are holding off on capital expenditures. When uncertainty rises, investment tends to decline. It's that simple. But here's the part most Indian investors don't think about. We may not be in the middle of this trade war, but we are very much exposed to its fallout, especially because how tightly our economy is tied to the US. Take the IT sector, for example. India's IT services industry, valued at nearly $250 billion, is essentially a bet on continued US corporate spending. Clients in BFSI, retail, and manufacturing drive over 60% of the sector's revenues. And when those clients start tightening their belts, the impact is felt almost immediately here. TCS just reported a 1.7% decline in net profit for the March 2025 quarter, their biggest miss in years, and they have only onboarded about 650 freshers this quarter. Now, that number used to be in tens of thousands. Infosys, Wipro, and others have issued cautious outlooks, pointing to delayed deal closures and budget freezes on the client side. And it is not just about revenue growth, it is also about jobs. The IT industry employs over 5 million people in India, and it is one of the few white collar sectors where freshers from Tier 2 and Tier 3 cities could get well paying jobs straight out of college. A slowdown here has a cascading effect. When people don't get hired, they don't move to cities. They don't rent homes, they don't buy furniture, take loans, or spend on discretionary items. It sounds obvious, but it's often missed in macro analysis. Recessions are not just about GDP, they're about mood, about confidence, and about flow. And the mood right now is cautious. India's GDP growth for FY25 has already been downgraded by several agencies. Moody's recently cut it to 6.1%, citing external headwinds and slower exports. That may not sound alarming at first, but remember, last year's growth was 8.2%, and we need over 7% just to keep absorbing our workforce meaningfully. Meanwhile, inflation is ticking back up, and despite the RBI's recent rate cut, the repo rate is now at 6%. So credit growth is already showing signs of cooling. So we are entering a phase where policy support may be limited, global demand may be weakening, and domestic sentiment may start to wobble. So, what does all this mean for you and me? The salaried professionals, the small investors, and the people trying to build a corpus slowly but steadily. It means that we need to start playing defense. And here's how to think about it. Let's start with people who have active EMIs, home loans, car loans, or even smaller personal loans. Your number one priority in a potential slowdown is liquidity, not returns, not upside, just financial flexibility. If your job is secure and your salary flow is consistent, great. But assume that it may not be 6 months from now. Build an emergency fund that can cover at least 6 months of household expenses, ideally closer to 9. Keep it in a liquid instrument. Think of high quality liquid mutual funds, overnight funds, or even a sweep in FD with instant withdrawal. The goal is not return here, it is access. And if you are on a tight EMI to income ratio, let's say 40% or more of your monthly income goes into repayments, then start reducing discretionary spends now and reroute those savings into cash reserves. Next, if you're someone who has been doing SIPs regularly in equity mutual funds, this is where it gets tricky. On the one hand, market downturns are the best time to keep investing because you get more units for the same price. On the other hand, it is not a blind faith game. You need to evaluate whether your SIPs are going into funds that have the resilience to weather a prolonged downturn. Funds which are heavily exposed to small caps or thematic bets might underperform or face sharp drawdowns. It may make sense to rebalance. Shift part of your allocation from equity SIPs to liquid SIPs or dynamic asset allocation funds. These hybrid products adjust exposure based on market conditions, and they're a good middle ground if you don't want to time the market but still want some cushion. Also, don't ignore gold. I know it's not flashy and people think of it as a grandmother asset, but gold has done exactly what it's supposed to do in times like these: preserve value. In fact, gold ETFs have seen record inflows globally over the last 3 months as institutional money looks for safe havens. In rupee terms, gold has crossed more than 80,000 per gram, not because of demand but because of risk aversion. Consider allocating 5 to 10% of your portfolio to gold, either via sovereign gold bonds, which also give you tax-free capital gains on maturity, or through gold ETFs if you want liquidity. Now, if you're somebody who has been waiting on the sidelines to buy the dip, I would say slow down. Not every dip is a buying opportunity. Sometimes it's just a signal that we're entering a new valuation regime. In a bull market, we get used to 60-70 PE ratios on mid caps like it's normal. But in recessions, fundamentals start to matter again. Look for companies with strong balance sheets, low debt, high cash flows, and consistent dividend histories. This is not the time to go YOLO and turn around stories. Stick to quality. Even if they fall further, they're more likely to survive and thrive once the recovery begins. Also, be cautious about real estate. A lot of people think a slowdown means that house prices will crash and they will finally get a deal. Maybe, but also consider this. In a recession, banks get stricter with lending. Developers delay handovers and resale liquidity dries up. If you're buying a home to live in, go ahead, but make sure that your EMI does not cross 30% of your net income. If you're investing, then wait. The risk reward is skewed. And one last point, stay close to information. These are the kind of markets where things move fast: policy changes, layoffs, fund manager shifts, even regulatory tweaks. And that is why we have set up a Telegram group where we're constantly discussing what is happening, what it means, and how to act. If you're looking for a community that makes sense of the chaos, not with panic but with analysis, then join us. The link is in the description. To sum up, recession is not a word to fear, it is a phase. It tests your patience, your preparation, and your ability to focus on what really matters. For some, it will be a setback. For others, it will be a reset. But for those who stay steady, stay informed, and stay liquid, it can be a setup. Play it right, and it could be the most profitable down cycle of your investing life.